Hi, I'm Jacqueline. I am a retired CPA that worked with 8, 9-figure billionaires and Fortune 25 companies. I was a tax planner in corporate America. I am very trained on how to read code and regs, and I am here to help self-made millionaires save more money in taxes so they can reclaim everything legally and increase their net worth because your tax bill is your biggest expense. So today we're going to talk about how do you know what is tax deductible in your 1040, and let's talk about how I profile my clients when I'm talking to them about what you're going to deduct, where you're going to deduct it, and how you're going to deduct it, okay? Because a lot of people come to me and they're like, oh, I talked to this guy and he told me I could deduct it, real estate. And I'm like, you got to be careful if you only have a W-2. So I need to understand how my clients' profiles are, and I break up their Form 1040 into 3 categories of income. And those 3 have different deductions based on the tax rules and the tax law. And I'm going to talk very generally, and there's always an exception to the rule, but I'm going to try to hit the general deductions and the general rules of what I've seen come through my sales funnel. So let's talk about this. We got the Form 1040. So everybody in the United States files a 1040. If you're not a resident, you're filing a 1040 NR, if you're green card, whatever. So let's talk about this. There's lines 1 through 10. This is where your income is, right? There's different types. So here we have W-2 and a few functions of other W-2 income. So we'll call it earned income. This is one category. Then we have investment income. So that's what we see on line 2 all the way down to line 6, okay? So this is interest, dividends, all kinds of different stuff. So this is what I call investment income. And this is important. And then we have line 7, which has your capital gains. And then after that, in line 8, we have flow-through income. So this is where rental income comes through, K1s, Form K1s from partnerships come through. This is all the income that's coming into your tax return. They consolidated on schedules now because it's gotten really complicated and they simplified our lives. And that gets you to your adjusted gross income. This is a super important number because your gross income tells you what your phase out is and how certain rules apply to what. So there's different lines with different definitions that we have to look to do our calculations. And this is all in the tax code. And this is why taxes are boring, because you don't care about that stuff. So when my clients come through, I am going to break this up into 3 categories when they talk to me. So we have active, we have non-passive, and then we have passive. If you want to learn about what happens after adjusted gross income and how this all consolidates in and works together, I have another video for that. Go back onto my YouTube channel. You can figure it out. But this is really important because each one of these line items is default classified under the code. And then you have to meet an exception to the rule to reclassify over, okay? So this is super important because it matters on how we look at tax deductible investments, how your legal ownership is, how much activity you spend in it, blah, 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 blah. Again, details that you don't care about. So let's talk about this. When I look at a W-2 or a 1040 and I have a client tell me, oh, I have a W-2. W-2 income, that line 1 goes here. That is active income, okay? So this here is going to dictate you're actively earning that income. You're spending your time to gain income. That is called active income, okay? So by default, W-2 is earned income. You're giving your time in exchange for compensation, okay? So this is very important. Investment income, it's sitting in a brokerage account and it's earning you money while you work, and you have a broker who is trading their time to charge you fees to make money. They are actively trading. We, as W-2 earners, are not. So this is where it's very important to reclassify. So investment income defaults to passive category, okay? All the way down to line 6. So 2 through 6 default generally into passive. And this is important as you're doing tax planning. It's not as simple as put my money in real estate, it's going to reduce my tax bill. buy some solar credits, it's gonna reduce. You don't know until you break this down and look at the tax codes based on your activity, how much time you're spending. It's really important. Capital gains, depending on your 1040 profile, could be active, and it could be non-passive, and it could be passive. It could be in all three of these categories based on how you're classifying what you do, when you do, what you do, how you did it, the way you sold it, okay? So this is very important. If you're selling a trader business that you had an S Corp that was a flow-through income, your capital gains are gonna go here. So if you're selling business assets, it's gonna go into active. If you're a real estate professional and you're selling a property, it's gonna go into non-passive. If you're not a real estate professional, which is very complicated testing under the 469 code, which you don't wanna go through, then you're gonna end up in passive. So if you're selling a rental property, it defaults to passive until you can prove under the tax code that you're active. Non-passive is what it is. So this is really, really important because as you do tax deductions, they matter. So all of these numbers basically add up into dollar amounts here. And when you add all three up, these three added together is your total adjusted gross income, and then you go and do the rest of the tax return. So let's talk about types of tax deductions and where they go. Depending on how your flow through is coming through, similar to capital gains, you can have different categories, right? So let's take a step back. So here, flow through would be business, would be income. That's active because you're trading your time to earn the income. Defaults by law. Then here, this would be like real estate, okay? Unless you're spending 750 hours, that's about 30 some hours a month on real estate, you're not gonna qualify for non-passive. Here, you have to be a real estate professional to get here, okay? And this is really important because it matters. So we wanna know how everything is categorized, right? And again, it's really important on the legal documents, and if you're not in the legal documents defaulted to certain classifications, it's gonna matter. So let's talk about this. Oil and gas, depending on how it's classified, this is one deduction, that tax deductible investment. So let's talk about these. For W-2, oil and gas. Oil and gas will always default between non-passive and active, depending on if you're a GP or an LP based on the tax laws. So this is where you're reading the basic law and then you got to get into the code and regs where there's the exception to the exception to the exception to the exception, which then puts it back into the exception. You got 5 exceptions, you're back to a different answer. So you got to pay attention and you got to know the rules. So oil and gas, if you're a general partner, it's active because that's a general partnership. It means you're trading time, you're spending time in it. And then if you're a limited or it's a joint venture, so you gave something up in exchange for a joint venture ownership. If you're a limited partner, you're just giving money and someone else is doing the work. So you're not active, but oil and gas has rules that reclassify it. Happy to chat with you if you're a CPA about that. So this non-passive is a hybrid between, it's not quite active, but it's not passive. So it's its own category. And this is a new one, new rules, didn't exist in 1986, tax code. So oil and gas is gonna fall under one of 2 buckets, okay? Then we look at real estate. I get told all the time, oh, I'm gonna do real estate. Well, real estate has lots of different ways you can invest. You can have your own business, real estate business. So this would be a realtor, a contractor, a developer. That is going to go here, right? You can also buy a short-term rental. That's a rental property, but under the tax code, short-term rental is non-passive, okay? So you have a business, it's like a hotellerie. So you're spending time and it's not passive, so it goes into so it's out of this bucket into here. If you have a long-term rental, it's passive over here, right? So these are really important to understand because these rules matter. Okay, so long-term rental is over here. If you're buying into a fund, there's different classifications, right? In fund land, You can be a GP, a general partner, or you can be an LP. LP defaults here unless you have a reason to move it to non-passive, which means you're spending more than 750 hours a year documenting it, following the rules to qualify. And then if you're a general partner, then it's going to go in the active business because that's your business, your general partner, you're actively working. Another of the top three that I always talk about when I do sales calls, there's three ways you have tax deductible investments. First one is oil and gas, second one is real estate, your third is acquiring businesses. Why? Because businesses are active, okay? And so each one of these goes into a bucket. And if you think you know the rules to become a real estate professional, I promise you, you're wrong. They're not simple. And I guarantee you your documentation is not where it needs to be because I've been through those audits. Why? Because I've been a real estate professional since I was 22. Isn't that fun? So don't think that you can skirt the tax rules and cheap your way out of this. It is definitely worth putting somebody in place that is your tax planner like me so you can get this help because your job is to go make money. I want you guys spending your time making money. It's my job to worry about your taxes. And at the end of the day, your taxes are your liability, not mine, so you're only as good as your advisor. So be really careful in who you pick and whose advice you're taking, because I will tell you right now, if you're getting a tax credit, you can't take a deduction. You don't get to double dip, and that's how the code works. If it walks like a duck and it talks like a duck, it's a duck. Whether it's a duck or not, the legal versus the substance really matters. So substance over form arguments. There's a lot of code and regs. I've been doing this for 20 years. It's not black and white. So get a tax planner to help you so you can not have to deal with all of this. And there'll be a return on investment better than you'll ever be able to get yourself. So if you make more than $250,000, click the link below and let's get you scheduled.